In the ever-shifting landscape of global finance, the ripple effects of the U.S. Federal Reserve's actions are felt far and wide, even in the bustling financial hub of Hong Kong. This week, HSBC Holdings plc, the UK banking giant with deep roots in Hong Kong, made a move that sent tremors through the city's financial arteries, a reduction in its key benchmark rate, the first such cut since 2019. The news arrived like a whisper, a subtle shift in the economic winds that carries with it both relief and concern. For homeowners and borrowers grappling with rising interest rates, HSBC's move brought a much-needed reprieve, lowering the cost of borrowing and offering a glimmer of hope for financial stability. However, the news was not entirely celebratory. For HSBC itself, the cut represents a potential hit to its margins, the very lifeblood of any financial institution. In an era of record profits, driven in no small part by the recent interest rate surge, this move signals a shift in the economic landscape, one that could put pressure on the bank's bottom line. The move was triggered by the Hong Kong Monetary Authority's decision to lower its base rate by 0.5 percentage point, a move directly tied to the U.S. Federal Reserve's own rate adjustments. This intricate dance of monetary policy, a delicate balancing act between economic stability and growth, is a constant game of chess, with Hong Kong's peg to the U.S. dollar dictating its every move. Our decision to reduce our Hong Kong dollar interest rates reflects both the U.S. Federal Reserve's announcement and the steady softening of HIBOR since the beginning of this year, explained Lewin Lim, Chief Executive Officer for Hong Kong at HSBC. This statement, with its measured tone, reflects the bank's cautious optimism, acknowledging the changing tides while expressing a willingness to adapt. The implications of this rate cut are far-reaching, touching not just HSBC but the entire Hong Kong financial ecosystem. Bloomberg intelligence analyst Francis Chan aptly describes it as a lot riding on the Fed's tightening cycle. Lower U.S. rates, transmitted to the local benchmark, could send asset yields and margins lower, casting a shadow on the fourth quarter and potentially spilling into the next year. The impact on HSBC, which counts Hong Kong as its largest market, is particularly noteworthy. As the bank navigates this new landscape, it faces a challenging balancing act, striving to manage expenses while maintaining a strong presence in a market that is now experiencing a shift in the economic tide. This move comes at a crucial moment for HSBC, a time of transition under the leadership of new CEO Georges Elhedery. The bank is focused on cost discipline, urging staff to prioritize efficiency and judicious spending. The recent slowing of hiring and tighter controls on travel and entertainment expenditures are clear indicators of this shift in strategy. However, the challenge lies in navigating this path without sacrificing the bank's competitive edge and its ability to serve its diverse clientele. The balance between cost control and growth, between maintaining profitability and adapting to changing market conditions, is a complex one, requiring careful analysis and strategic foresight. HSBC's decision to lower its Hong Kong dollar deposit rates by 25 basis points to 0.75% further underscores the delicate dance between maintaining liquidity and adjusting to shifting market dynamics. In the face of potentially lower returns on deposits, the bank seeks to maintain its attractiveness to depositors while adapting to the new realities of a lower interest rate environment. The rate cut is not an isolated event, but rather a reflection of the broader economic landscape. The U.S. Federal Reserve's recent tightening cycle, a complex attempt to curb inflation without triggering a recession, has sent ripples throughout the global financial system, affecting everything from borrowing costs to asset valuations. Hong Kong, with its deep economic ties to the United States and its currency pegged to the U.S. dollar, finds itself caught in the middle of this complex interplay. The consequences of the Fed's decisions are felt acutely in the Asian financial hub, influencing everything from the value of the Hong Kong dollar to the profitability of local businesses. The rate cut is a reminder of the interconnectedness of the global economy, where the decisions of one central bank can have cascading effects on others. It highlights the need for adaptability and resilience in the face of shifting economic tides. For HSBC, the rate cut represents a strategic maneuver, a calculated adjustment to the evolving economic landscape. The bank must now navigate this new terrain with deftness and foresight, balancing cost control with growth, profitability with adaptability. The broader implications of this move extend beyond the financial realm, touching the lives of ordinary Hong Kong residents, businesses, and investors. The rate cut, though subtle, represents a shift in the economic landscape, one that will require careful monitoring and strategic planning to ensure long-term financial stability and prosperity. This is a story unfolding in real time, a narrative of shifting sands, of economic adjustments and strategic maneuvers. As the global financial landscape continues to evolve, it remains to be seen how HSBC and other financial institutions will navigate this complex and dynamic terrain. One thing is certain: the decisions made today will have long-lasting consequences, shaping the future of the Hong Kong financial market and the global economy as a whole.